Hello friends, welcome to the second video from Scholars Club. In this video, we'll discuss about accounting concepts, conventions, types of accounts and golden rules of accounting. Now, we'll start off with accounting concepts. These are the main and important accounting concepts. And the first one, the separate entity concept. This concept says that we have to maintain accounts of business and owners separately. And next, the money measurement concept. This concept says that every recorded event and transaction should be measured in terms of money. And next, the cost concept. This concept says that all assets are recorded in the books at purchase prices only. And next comes the going concern concept. This says that an entity will remain in the business for the foreseeable future. It keeps in mind the company will last long. Next comes the dual aspect concept. This concept says that underlying basis of double entry system. I'll be explaining detail about the double entry system while solving some problems. And next comes the realization concept. This concept says that revenue can only be recognized after it has been earned. And next comes the accrual concept. This concept says that expenses and revenues are recorded in the period they occur irrespective of cash involvement. It means all the expenses and income should be recorded in the actual period irrespective of the cash involved in the transactions. These are the concepts of accounting, and then comes accounting conventions. Conventions are the customs and traditions which guide accountants while preparing accounting statements. They take help of these conventions to prepare the statements. There are four accounting conventions. There are consistency. This is a convention which says that the same accounting principles should be used for preparing financial statements. And next comes the full disclosure. As the name suggests, the company has to fully disclose all the necessary financial information. And then we move on to conservatism, which is also known as doctrine of prudence. It says to anticipate future possible losses but not future possible gains. It says to play safe. And the last, the materiality convention. This convention says only those transactions will be considered which have material impact on financial status of the organization, and other transactions should be ignored. Now we have discussed about accounting concepts and conventions. Now, what is an account? Yes, account is a summary of relevant transactions at one place relating to a particular head. It says account is a summary of relevant transactions at one place for a particular head. It is a summary of all the transactions which has happened at one place for a particular head. We can also say it as a particular person or particular business account. It records not only the amount of transaction but also their effect and direction. It says it not only records the transaction and the amounts but also their effect and the direction which they move and how they affect the other accounts. And next we discuss about classification of accounts. Accounts are classified into personal account and impersonal account. Impersonal account is further classified into real account and nominal account. Now we'll see what are these accounts. Personal accounts. These are the accounts of persons with whom the business deals. For example, we can say Ravi account, Raju account, the accounts which are personal. Then comes the real accounts. These are the accounts of tangible objects or tangible assets. That is, assets owned by an enterprise and carrying probable future benefits. And then comes the nominal accounts. These accounts are open to explain the nature of their transactions. The nominal accounts include accounts of all expenses, losses, incomes and gains which can be said as wages, salaries, etc. Now we'll discuss what is debit and what is credit. As debit and credit carries a lot of significance in maintaining accounts. Yes, debit means to enter an amount of transaction on the left side of the account. Credit means to enter an amount of transaction the right side on an account. Yeah, we'll discuss on this more when we prepare our ledger accounts. We'll generally indicate debit as DR and credit as CR. Both debit and credit may represent either increase or decrease depending upon the nature of an account. It says debit and credit represent either increase or decrease. That depends on the nature of that account. Now we'll discuss about the golden rules of accounting. As the name suggests, these are the golden rules which carries a lot of importance in accounting. The first golden rule for personal accounts is debit the receiver, credit the giver. Next comes the real accounts, debit what comes in and credit what goes out. Then to the nominal accounts, debit all expenses and losses, credit all incomes and gains. These golden rules of accounting carries a lot of importance for preparing the financial statements right from journal entries. And this comes to the end of this video. In the next video, I will show how to apply the concepts, conventions and these golden rules which we have discussed in this video to pass journal entries, and in the further videos to pass the ledger, to post the ledgers, to the trial balance and also to the financial statements. Thank you. I think you have liked this video. If you like this video, please click on the like button and don't forget to subscribe and encourage me for more this kind of videos. Thank you.